And to this chart, we can clearly see that the recent break of structure was exactly right here. This blue line was the recent break of structure, and right now we can clearly see that price has been creating valid pullbacks to the downside. I mean bearish pullbacks. You can see that's another, yeah, this one here is another valid pullback, and also I see another valid pullback of which its high, it's this one here. So I don't see any other valid pullback here, and this one here is the recently formed valid pullback high, and we say that the liquidity resting above this recently formed valid pullback high is called the inducement. And in this case, since it happened after the break of structure, then it's called a major inducement. So you can clearly see here price retraced and took out or grabbed this liquidity resting above this major inducement, confirming this one here as a swing point, and meaning if price then reverses and breaks past the swing point, then that's a confirmed valid break of structure. And so right now we can clearly see price reversed, took out the major inducement, confirmed this one here to be a swing point. It reversed and broke past that swing point, confirming a bearish break of structure to the downside. So this means now we are in a new trading range. Exactly right here, we are in a new trading range with this one here, I mean this high being the high of the trading range, and the low currently here, but it's not a confirmed swing point low because the inducement is yet taken. So that's the high and it's confirmed. All right, so right now if I am to mark the inducement, I'll mark this one here, and in this case it will be a minor inducement because it occurred before the break of structure. All right, so let me continue mapping price and see what price. All right here we can clearly see that price took out the minor inducement, but the retracement here was by 2 candles, and I said a takeout of an inducement by less than, or yeah, by less than 3 candles, that's not a valid retracement. We can clearly see the opposing candle or the retracing candles, they are less than 3. So this means that this one here is not a valid break of structure. So this one here, I mean this inducement will shift to this one here. So this high will be now our new inducement. All right, so let me mark that. So we'll be shifting the inducement to this high. So if now price takes out, or if now price creates another pullback, then I will be shifting down. But something you need to know is that this one here is not a valid break of structure because the retracing candles we are less than 3 and we need at least 3. All right, so let's see what price actually does. Let me continue running price. All right, price is actually heading down and down. Price created here another valid pullback, and we said the inducement is actually the recently formed valid pullback. So this means that's the major inducement currently. All right, so let me continue mapping price. Right, price created another one here. You can see this one before it actually took it out. Exactly right here, you can see that was a valid pullback. So this one here will now be the major inducement. So if price takes us out, then this one here will be a confirmed low. And once I run price, you can clearly see price took out the the major inducement exactly right here. So this one here is there. So that's a confirmed low. And right now it's the right moment to mark the POIs. And we said that the order flows are primary and the order blocks are secondary. So starting with the order flows and starting also from the extreme of our range. All right, this is the extreme and this one here is a confirmed low. So this one here is a low of our trading range. So this means that starting from this high all the way down here, that's now our trading range or our impulsive move. So on the range, we can clearly see that this one here is the extreme, the extreme order flow, and this extreme order flow is mitigated, so that's not valid anymore. So I'll shift to the next, and this next one now it's not mitigated. We said a mitigation by an invalid pullback is not a valid mitigation. So right here we can clearly see that this one here is not a mitigation. In fact, that's not a valid pullback. So a mitigation by an invalid pullback is not a valid mitigation. All right, so where is the engineering liquidity? So now the engineering liquidity will be this one here. So that's the engineering liquidity. And let me delete this, or let me just leave it so that you know that this one here is not a valid break of structure. That's not a valid break of structure because the retracing candles was less than 3. All right, so right here I don't see any. Right, there is this one here. I mean, after here I can see this one here as the other POI, and I can also see this one here. All right, this, you can see this pullback here, it didn't mitigated before. Here you can see price didn't mitigated it here. So this means that this one here is the decisional POI. I mean the decisional order flow, because we say that the decisional order flow, it occurs immediately after the inducement is taken out. So this means that this one here is not our decisional. This one here will not be our decisional, but it will be now our smart money trap. So this one here is the decisional, and this one here is the extreme. I will not take the trade from this one because it's nearly, you can see like it's almost even not like at least it would have been something like nearing the 38.2 of our trading range. Yeah, it will be making sense because even if I take the trade from here and target the external liquidity, I will get a very small risk to reward, probably less than 1:3, and it wouldn't be favorable, or it wouldn't be meeting my rules. Right, so right now if I am to take this trade, I will only be waiting for a sweep past, I mean a sweep past the engineering liquidity, or a grab of the engineering liquidity, or a mitigation of the extreme, extreme order flow. All right, so right now I think it's worth it to place a sell limit order from this high all the way, yeah, from that high, and obviously stop loss needs to be safe. I will place the stop loss exactly at the external liquidity because this one here is a major inducement, and of course targeting our low right there. So this here is a worth it trade even without waiting for a confirmation. That's worth it for me to do that because the risk to reward here is favorable. You can clearly see that the risk to reward on this trade or on this sell position is actually 4.88. So that's a favorable risk to reward. And this one here I said it's a smart money trap because we can only have a maximum of 2 valid POIs in a trading range. So we have got this one here as the extreme, this one here as the decisional. This one here is valid, so if price actually reverses from there, then this one here will be a valid break of structure. But I will not take that trade because even if I take that trade, it will not give me a reasonable risk to reward. All right, so let's see what price eventually does. Right, price is actually, right, price violated the decisional POI exactly right there. Yeah, you can clearly see price violated the decisional POI. So right now I'll be looking forward for price to either sweep the engineering liquidity or mitigate the extreme order flow. So if price sweeps the engineering liquidity, I will take the entry and delete this sell limit order, or I can leave the sell limit order and also take this entry. It's actually upon my decision. All right, so let me see what price does. Right, so price is heading up, and exactly right here we can clearly see that price has swept the engineering liquidity. So this one here is a valid entry module. That's what we called the engineering liquidity sweep. So right now I will be taking this trade, and yeah, right here I'll wait for a good bearish momentum, but I can still even take it right here because this here is a confirmed sweep, and of course stop loss above the sweep and target profit the external liquidity. And you can see the risk to reward is 1:3.6, nearly 1:4. Right, so let's see. And by the way, there is still a sell limit order here, meaning if the engineering liquidity sweep fails, then price will need to trigger me here because I usually like placing limit orders on the extreme POI because the extreme POI is actually the last POI on the range, and if price fails this one, then you'll be uh then price will be looking forward to make a change of character. So now let's see what price does. All right, so eventually price violated the sweep, meaning it stopped me out on this first trade. So this here is our first loss, and now price has mitigated the extreme, the extreme order flow. So let's see if price will eventually respect the mitigation. Right, and exactly right here we can clearly see price is heading down and down and down and down. Alright, so let's say I didn't place this sell limit order like exactly after price has failed this engineering liquidity and waited for price to give a reaction from this POI, then my entry would have been from this reaction, stop loss of course above there, and target profit below here. So you can see that's a 1:5. It's also good, but I usually prefer placing sell limit orders because sometimes placing sell limit orders will give you a good risk to reward than waiting for a reaction from the POI. Alright, so all of these are ways you can enter based off the order flow. Alright, so I will just stick with what I did earlier, and finally price managed to achieve towards the external liquidity exactly right there. So I was stopped out here, but the loss, this loss was now like this win engulfed this loss, so I'm now positive. Alright, so this means we are currently in a new trading range because price has made it out to the external liquidity. So onto the new trading range, exactly here we can clearly see that this one here is our high, and yeah, so let's see in our new trading range, where is the inducement? Exactly right here, that's the minor inducement. Why minor? Because it is formed before the break of structure. Alright, so let me run price. Right, price has taken out the minor inducement, so this is the moment to mark the POIs. But like I said, I don't like taking trades that involve the minor inducement because the minor inducement is less impactful, less significant compared to the major inducement. Trades that involve the major inducement have a higher possibility or higher chance of winning than trades involving the minor inducement. So right here we can clearly see price has indeed taken out the minor inducement exactly right there. So this means this one here is our confirmed low, and if right now if I am to mark the POIs, then of course we do start with the order flow. So this order flow is mitigated, and right here this here is the next order flow. So that's the next order flow, and this order flow is not mitigated. So this means that if price, this means that this one is the extreme order flow, and I don't see any other order flow down below here. So this means that there is no decisional order flow. So we only have the extreme order flow. And if I was to mark the order block, the extreme order block, because this extreme order flow is not on the extreme of our trading range. So on this extreme order flow that was mitigated, there is an order block above here that is still unmitigated. All right, no, this is actually the order flow, but the order block is this one here. So this order block is the one that is unmitigated. So right now, if this extreme order flow fails, then I'll be looking forward to take the entry from the extreme order block. So let's see. Of course, the trading range ranges from this high all the way to this low. All right, so let me run price and see what price eventually does. All right, so right here I'm waiting for price to go onto the extreme. Alright, eventually price decided to give the reaction after price has already taken out the minor inducement. It didn't even made it out to the extreme order flow or the extreme order block. But since the minor inducement is taken out, I said it doesn't matter if the inducement is a minor inducement or a major inducement. Once the inducement is taken out and once an inducement is taken out, either minor or major, this one here will be a confirmed swing point, and price actually reverses and breaks past that, then that's a confirmed valid break of structure. So this means that we are currently in a new trading range. And by the way, if you notice, this is actually the true SMC way of marking market structure. So yeah, right now this one here is the trading range high, and right now where is the inducement? Of course this one here is the inducement, and in this case minor inducement. So let's see, Right, so price is heading towards the minor inducement. Of course, price created another inducement here. So this one here is the inducement. This one here cannot be the high because it's engulfed inside this order flow. You can clearly see that all of that is engulfed inside this order flow. So this means that this pullback here, this pullback high cannot be the major inducement. If I am to take this here, I'll be wrong, and this one here will be the correct one. Right, so let's see what price does. Will price take out the major inducement? This one here is the major inducement, so this means this one here is no more inducement. Right, so if price takes out the major inducement, that's when now I'll be marking the POIs. Right, and exactly right here, we can clearly see price swept the inducement, but it didn't give like a reasonable reaction, bearish reaction. It gave an incomplete evening star pattern, because for this to be a complete evening star pattern, I will need at least for price to break past the 50% of this bullish candle. If price had broke past the 50% of this bullish candle, then that would have been a valid evening star pattern, and that also will be a valid entry module, that is a major inducement sweep, and that's the first entry module as I showcased on the video course. So this means now if price goes all the way up without making another bearish candle, then that means that that sweep or that inducement sweep is no more valid. All right, so this one here is that's a confirmed swing point because the major inducement is taken out. So this means we have like our full trading range from that high towards ending at that low. All right, so let me continue running price, and exactly right here. Oh, by the way, after price has taken out the inducement, that's when now you start mapping that's when now you start identifying the POIs. And like I always say, the order flow is primary. So right now I can clearly see that this one here is the extreme order flow and it's already mitigated. And if I check out for another order flow, I can clearly see this one here, and this order flow is not mitigated because this candle engulfed all this, and this here is the decisional order flow. This one here is the decisional order flow. So a good reaction from the decisional order flow will confirm the entry, and so a good reaction from the decisional order flow will confirm a valid entry, as well as a good reaction from the extreme order flow. And this one here will be our engineering liquidity. Right, so let's see if price eventually creates a good reversal. And exactly right here I can see this good reversal, good bearish candle, and stop loss above there, and of course target the external liquidity. I'll need a 1:2, and since this here is a major inducement, there is a higher possibility that even if I extend past the external liquidity, price may end up hitting my TP. All right, so that's a valid entry, and let's see if price respects the decisional order flow. And exactly right there, price stopped me out, and right now I will not risk any entry. Even though price is giving me some bearish reaction, I will not take that entry. I will now wait for either a sweep of the engineering liquidity or a mitigation of the the extreme PY. In fact, here, since the extreme PY is on the extreme, I can actually take the sell limit order, put my stop loss of course above that high, and target profit here, and this will give me a reasonable risk to reward. You can see that a 1:3, and that's a reasonable risk to reward. So let me extend this and run price so that we can clearly see what price eventually unfolds. Right, so price eventually, you can see if I had to take the entry again from this decisional PY, I would have ended up being stopped out again on the same decisional PY. Right here, this is not a valid sweep, and so I'll be waiting for a mitigation on our extreme order flow. Right, and exactly right here, price mitigated the extreme order flow and is giving out the reaction. All right, so let's say let's say you didn't set the sell limit order and you had to wait for the reaction, then your entry would have been here. You can see right here, after price has made that beautiful evening star pattern, and obviously your target profit will be exactly right there. So you can see in this scenario you had spot, like you will have a less risk to reward than me, who had placed like a sell limit order directly there. And also on top of that, your stop loss is above this evening star pattern, but my stop loss is above the external, I mean the external liquidity or our trading range high. So you can see I have like my sell is more secured than yours, and I'm also getting a good risk to reward than yours. So placing a sell limit order from the external, I mean from the extreme order flow or from the extreme order block, is better than waiting for a reaction from it, because if price fails this extreme PY, this means now the whole setup is like the whole setup has now failed, because price will now be changing bias from being bearish to now being bullish. All right, so let's see if price ends up being, and exactly right here you can clearly see price made it out to the external liquidity exactly right there. All right, so you can clearly see that even without knowing about the, I mean, without knowing about top-down analysis, you can still be profitable with just trading one time frame. I'm not saying that top-down analysis is bad, but if you find it frustrating, try only focusing on one time frame, and I will recommend the 1 hour time frame, and you may be surprised it might work for you.